Good morning, everybody, and welcome to this October version of the IFRS and Corporate Reporting webinar series for 2024. As all of our regulars will know, and some maybe if you're new, my name is Kevin Frohbus, and I'm a partner in the Corporate Reporting and Sustainability Reporting teams at Sydney at BDO. And there's a new face on the screen. I'd like to introduce Mark Pizzagella. In fact, Mark, you can do your own introduction. It's not Aletta. He's not pretending to be Aletta. Mark will do his own introduction. He's come to do a little session today. So Mark, can you introduce yourself quickly?
Sure, thanks, Kevin. Yeah, so my name's Mark Pizzagella, and I'm the lead partner in relation to our BDO Connect network around Australia. And so Aletta and Kevin have been kind enough to invite me along just to give a really brief presentation as to what that involves and how you can be involved.
Mark, we're happy to have you here. And I will say that Aletta is currently dealing with an IT issue. So it's possible she may pop up at some point, but if not, we're perfectly capable of moving along without her. So I will bring her face up on the screen and say that, you know, today's presenters is myself and Aletta as per normal. Sure. And Mark, just for your context and those who are on the webinar, we do sometimes have some IT oopses, and we deal with them like rational professionals, where the duck is perfectly calm on the top of the water and we're paddling hard underneath. So if Aletta doesn't join us today, you have me for the next hour to talk about the pitfalls of share-based payments. Before I get Mark to do his little spiel, I'll just do an acknowledgement of country and say that, you know, we acknowledge the traditional owners on the land which we meet, and we pay our respect to elders both past and present. And right. In terms of where we are rapidly heading towards the end of 2024. In fact, Aletta and I are busy working both within the corporate reporting team as well as the sustainability teams more broadly to essentially put together the webinar series for the current for 2025. So you'll see those coming out soon. Where we are today in the corporate reporting webinar series is the pitfalls of share-based payments. And it's actually the last topic of the year, which is essentially a throwback to something that's perhaps maybe a bit old and something that's sort of already embedded in corporate reporting culture, because from next month, we start to head into our rapid series of year-end preparation webinars. So if there's any webinars in terms of preparing for your year-end, both sustainability and financial reporting, then the next two are the ones you want to come to. And the one in November, the 20th of November one, that one will actually be dealing, I think it'll be an hour and a half as per normal. So it'll be quite a big one. And I see Aletta's joined us. So Aletta, your timing could not be any better. In terms of the sustainability webinar series, same thing, rapidly heading towards the end of the year in terms of the series. And on the 30th of October, which is next week, we'll be looking at understanding relevant climate-related metrics. And that starts to kind of bring to the end a series of webinars where we've been looking at voluntary and sustainability reporting. We've been looking at governance. We got into risks and opportunities. We got into climate scenario analysis. We've done some strategy and risk. And then we'll be heading to metrics. And metrics lead to target setting, which is then in November. And we'll bring it all together on the 18th of December and almost sort of put a wrapper around 2024 and bring it all together in terms of, shall we say, the mandatory report and what the climate statement will look like. And then back by popular demand, and I want to say it's not so much popular demand, it is surging demand, not even popular demand, the carbon accounting masterclass. Why is it surging demand? Because the mandatory sustainability reporting is now mandatory. The legislation has been passed. We'll deal with that a little bit later on. But we will be doing a series of carbon accounting masterclass all across the country, as well as a virtual one. You can see they're all sort of November, with the Perth one in December, and they'll be kicking off soon. We did do this earlier in the year. It will be held face-to-face in our training venues around the country, except the virtual one, of course. and it will be essentially your foundational to carbon accounting masterclass under GHG protocol. So looking at boundary setting, moving through to scope 1 and 2, and then scope 3, talking about data and even software, and what the various alternatives in terms of software platforms are. So there's a lot to cover in that day. Please go onto our website for registration if you can. And also treat it as a networking opportunity. We'll have a lot of people there from all sorts of entities, heavy emitters, right down to service organizations. So come along and meet our partners as well as the other delegates. With that, I'm going to hand over to Mark, who's going to do a little talk on Video Connect. So Mark, over to you, and I'll drive the slides so you can tell me where to go.
Thank you very much, Kevin, and thanks to Aletta again for having me along. So look, just a very brief presentation about BDO Connect, and as Kevin's just put the slide up, what BDO Connect is, it's a membership base that we have here at BDO. It comprises SME accountants, boutique advisors, wealth advisory advisors, legal practitioners, and we bring together all of these people under an umbrella called BDO Connect. And essentially, all of the people that are members of our group can access, various BDO specializations that might be outside of their skill set, and just bringing together like-minded people. So if you go to the next slide, Kevin, you'll see that by being part of the BDO Connect group, you get exclusive benefits, including having direct access to BDO experts about a whole variety of things. So obviously you know about Aletta and Kevin, but it might be a tax issue that you need or other issues that might be of concern to you, and we direct you to the relevant people within the BDO network. Telephone inquiry service, where, if you want to have a brief call about a particular matter, you can do that. Regular technical updates, exclusive training, seminars, webinars, and being involved in networking functions and conferences that we hold. So if things become a bit more complex though, obviously we can provide a fee quote and tailor a particular advice to your needs depending on what that is. If we go to the next slide, Kevin. So in order to make this work, we've got a number of non-negotiables for our success and for your success in terms of the way we interact with each other. We ensure that there's no poaching. So there's no poaching of clients if you're a practitioner, no poaching of staff if you're in industry. That would not be a pretty good business model, I don't think, if that's the sorts of behaviours that go on. So that's a strict policy. We return calls timely, and there's a genuine care about the way we go about it to make sure that you're getting the best person within the BDO network, or if we believe there's a better person outside of the BDO network, we do that as well. So our main concern is getting you the best result. It is a team sport, so it is accepted amongst the BDO partners that we do this together to bring together the right people for the particular job that you've got at hand, and we're in it with you for the long run or the long haul. In other words, what I mean by that is we're not here to have a quick conversation and try to generate a fee. It's really about making sure that whatever your inquiry is, we're addressing it, and we can either try and address that internally, or as I said before, if we think there's someone better outside of the BDO network because of a particular reason, or it could be a cultural fit or whatever it might be, we do that as well. Kevin, thanks, Kevin. So you're more than welcome to, with the QR code, jump onto 3 Minutes with Mark. So that's my monthly video series that I've got. Please patch onto that, and it'd be great to have you on board as a listener. And more importantly, if you go to the next slide, Kevin, with this QR code, you can actually join BDO Connect for free and be part of the BDO Connect group. We've got in excess of, look, don't quote me on the numbers, but it's in excess of 3,500 to 4,000 accountants, advisors on our network around Australia. So, and it's growing, and we'd love for you to be a part of it. So just wanted to thank Aletta and Kevin for allowing me to share that.
Thanks, Mark. Thanks for coming along, and I'll just give it a bit of a shout out from our side. So we obviously engage with the network ourselves, especially from the corporate reporting side, and obviously now sustainability and sustainability reporting more generally. We've just had our conferences, Mark. You obviously would have been been part of that, but there was a whole series of conferences where we had professionals. I think that's an annual conference. I'm kind of going to say I think it's annual.
Yes, it is.
it's lovely to see all the guys in the room. We had a great day in Sydney. I'm sure they had them around the country as well. So come along. It's a fantastic network to be involved in.
And it's a
Thanks,
great way
Mark.
to get your CPD hours as well, or increase your CPD hours. Yep.
Also, you could just get to meet
Yeah.
me and myself and Aletta. So isn't that enough? All right,
Exactly.
Mark.
Thank you
Thanks
very
very much
much, and
for
have a great
joining.
session.
Thank you.
Okay.
Thanks, Mark. Have a good day.
You too.
Right, we'll just jump into it today. We saw Aletta for a brief moment. She appeared on a spectra on my screen, but then she's gone away again. So I'm just going to keep going, and I'll jump straight into latest sustainability developments. I mean, we always do this session just to keep you informed of where things are and where things are heading. So as you would probably know on sustainability reporting, the legislation received royal assent on Tuesday, the 17th of September. And following hot on the heels was the approval of the standard itself. This is from the AASB, so the S2 standard. The S2 standard being dealing with climate-related financial disclosures itself. And then hot on the heels from that, the international body that deals with assurance standard issued the proposed standard on assurance, or at least that filtered down into Australia into an exposure draft for assurance. Now, Aletta said this was the best month in her life ever, and I see she's on the screen again, so maybe you want to jump in whenever, Aletta, and talk. But really, everything happened in September for Aletta. She'd been working really hard, and we've been really working hard at BDO for the last 3 years to essentially set this up in terms of BDO assisting our clients with it. So it all came to fruition. And this is why the Carbon Masterclass is suddenly the hottest ticket in town, because, of course, one of the elements of the standard on sustainability or mandatory sustainability is, of course, carbon. Everything starts there. Measuring your carbon, setting your targets of carbon, and integrating that through your organization all starts with carbon accounting. So it's the gateway topic. And that is why the masterclasses are going to be really, really important going forward. I actually might ask Aletta to talk to this. This is her little baby, not because I can't talk to it, but because Aletta loves a decision tree. And she loves the decision tree. So Aletta, do you want to have a go at talking about your wonderful decision tree here?
Yes, so first of all, Kevin, I have to say the IT bugs have been running around my house and all our systems this morning, and I'm just very relieved that I can join. I did briefly join earlier before Mark presented, but I had no sound, so I could see your mouth moving. I could hear Mark talking, but no sound. But wonderful to be here, and apologies for the IT issues. So this decision tree is trying to articulate which entities in Australia is captured by mandatory sustainability reporting as required by the new legislation in the Corps Act. And previously we had a table where we outlined that there were 3 criteria. There's a size criteria, there's a whether you're an Enger reporter criteria, and then the 3rd criteria is around whether you're an asset owner. However, the questions came fast and furious, and clients were saying, how do these interact? Do I have to meet all of them, just one of them? Very complicated. So we've put together a decision tree, and the very first question here is actually the most important question. Is the entity lodging a financial report with ASIC as required by Part 2M of the Corps Act? So if you are lodging accounts with ASIC as required by Part 2M, you would be potentially in this regime. If you say no to this question, you're out, right? So stop worrying. You can consider voluntary reporting, but you're not captured. So if you're within that regime, the next thing to think about, and this is an important one, is the entity a subsidiary whose ultimate Australian parent entity prepares and lodges a consolidated sustainability report with ASIC? Because if you say yes to that, you yourself are also out of this regime. With financial reporting, subsidiaries of ultimate parents could be out and get relief from lodging financial reports, but there's a class order they have to apply with, and it's got to do with, one of the key things is a deed of cross guarantee. Here you can see it's easier to get out of the regime around sustainability reporting. You don't need that deed of cross guarantee. You just have to be able to argue that your ultimate Australian parent is doing a sustainability report, actually a consolidated report, which includes you. So those two dark grey boxes are actually quite important. And then we go through the interaction of the other things. So the first one, are you a registered scheme, registrable superannuation entity, a corporate collective investment vehicle? So basically, are you an asset owner? Again, if you say yes to that, it depends on whether you've more than 5 billion of assets under management or not. If you have, you are definitely group 2. Otherwise, we look at some of the other criteria. Then we look at the normal size thresholds. You have to meet 2 of the 3. And then there's also an angle around NGER reporting. So this decision tree, I think, is just to try and step clients through the thinking. And you have to step each entity within your group through this decision tree. All right, so if you've got a parent and 5 subsidiaries, for each one of them, for each of the 6 entities, therefore, you start by saying, is this particular entity lodging with ASIC, etc. So I think it's a very useful decision tree, but that's how you would apply it. Kevin, I'm happy to maybe finish this section if you don't mind going to the
Sure,
next
absolutely. I might just make a comment here on the decision tree and just reiterate what Aletta said. It is the starting point, and I'm having a lot of fun in the bottom left-hand side of this diagram in the NGER world, because the NGER reporter, as defined, doesn't quite align as nicely as you think it does with the reporting entity under the Corporations Act, although I think the intention was to align them. And in many ways, where it doesn't align is when you've got a subsidiary in a group that has a parent that might not be the controlling entity under the NGER legislation. Now, if you don't understand anything I've just said there, that's probably because you aren't an NGER reporter. But if you are an NGER reporter, lots of fun interpreting this. So before you dive into anything, make sure you have determined the correct reporting entity for the mandatory reporting regime, and then you can dive into it from there. So I'll move on to the rest of this. Happy for you to finish this section.
Correct. And then the reporting timeline is very important. Once you know that you're within the regime and whether you group 1, 2, or 3, this table is trying to give some guidance on when you have to do the mandatory reporting in your annual report. The legislation is drafted fairly interestingly, because it says if you group 1, it applies to financial years beginning on or after 1 January 2025. But for group 2 entities, it's for years beginning on or after 1 July 2026, and for group 3, 1 July 2027. So there's an 18-month period, let's say, between the start date for group 1 and the start date for group 2. So it's a January-July interaction, which is often a bit confusing, and we've tried to clarify it here, linking it to common year ends. And then on the next slide, the Australian Auditing and Assurance Board came up with an exposure draft on how they would like to introduce assurance. I should start by saying reasonable assurance is what we know as normal audit, highest level of assurance you could ever get. Reasonable assurance, normal audit, substantive procedures, etc. Limited assurance is what you would refer to as a review. So it's often what we have for half-year review of financials. It is more analytical type procedures, holistic procedures. So what they're trying to do here is do a limited assurance for a few years and then full audit, like you have on a financial report, for a full year from the 4th year, so roughly 30 June 2030. but also as an additional transitional support in the very first year. Although you have to comply with all the disclosures of AASB S2, with the exception of Scope 3, which has a delay of a year, only the governance disclosures, the risk and opportunities under strategy, and Scope 1 and 2 will be subject to limited assurance in that first year. So again, the Auditing and Assurance Board trying to provide some assistance, and the legislation provides some limited liabilities for directors in certain situations as well. So we just wanted to come back to that. Still, I would say the hottest of hot tickets in town is this particular roadmap, where clients are saying to us, please tell us how to get started, where do we start, how do we get ready for 30 June 2026 if we are Group 1 and a 30 June year end. You can see for the 30 June 2025 financial year, there's a number of things that will have to happen. So under carbon footprint, you have to do your boundary setting, you have to do a basis of prep, you have to measure Scope 1 and 2. We recommend that you also do a initial calculation of Scope 3. Under the second project stream, climate risk assessment, scenario analysis, financial modeling, and we are proposing a dry run or a draft disclosure of AASB S2 so the directors can see what will go to the market a year later. So this is just for internal purposes. If you look at sustainability strategically, you will look at Scope 3 or project stream 3. And I want to say this, invariably, or actually I'll put it differently, each and every time we've done stakeholder engagement with a client that don't have to do any mandatory reporting, but we're just doing stakeholder engagement, the number one item each and every stakeholder of each and every client is asking for is carbon footprint, which brings us back to project stream 1. So if you look at this and you're a small, medium-sized business and you may be Group 2, Group 3, or you're an SME, you're never going to do mandatory reporting. I can tell you now, you have to do project stream 1 as soon as possible. Measure your carbon footprint. It's a strategic imperative, a commercial imperative. And then you don't have to worry about project stream 2 because you'll never do that mandatory reporting. So if you look at this strategically, stream 1 and 3. If you look at this only compliance, stream 1 and 2. If you look at that strategically and compliance, all 3 streams. Kevin, happy to go on to the pitfalls of share-based payments.
Yeah, thanks, Aletta. I think, look, I'm driving the slides today, and I'll give you a bit of a hint in terms of how the sausages were made. Aletta did the slides, but I think I'm going to drive them, and what we're going to do is we're going to just kind of back and forth between the message we want to share today. So thank you, Aletta, for first of all getting online. I think that was your challenge of the day, was to actually get online. But thank you for that as well. And like I say, it's actually nice to come back to a good old-fashioned corporate reporting topic, but we are thick in it, both Aletta and I and all our teams in the sustainability world at the moment. So perhaps the first message of the pitfalls of share-based payments is not to take your eye off the ball. Yes, it's all about carbon and it is all about sustainability, but the other things carry on, and share-based payments are still happening out there and need to be accounted for correctly. So let's talk about that for the rest of this session. I'm gonna just start talking. Aletta, you're gonna jump in when you have a war story. I got a lot of war stories to tell. What's amazing to me when we put these topics together, and I think Aletta put this topic in over a year ago now when we planned the year out, it amazes me how by the time we get to actually do the webinar, suddenly the topics actually have become relevant because we've seen a whole bunch of new transactions that involve these things. So the war stories I've had today that I'll share with you on share-based payments are all things that have come across my desk in the last, let's say, 6 months. Which means this topic is still relevant. Entities are still issuing or entering into transactions that involve share-based payment transactions, and the types of schemes we're seeing are evolving all the time. So they're definitely out there. But the big picture with IFRS 2 or AASB 2 that deals with share-based payments is that a share-based payment transaction in which an entity acquires or receives goods or services is scoped into IFRS 2. And like all standards, you've got recognition, measurement, and then sort of three types of measurement that go with it. You've got your equity settled share-based payment transaction, your cash settled share-based payment transactions, and then your share-based payment transactions with cash alternatives, almost like a hybrid between the two. Now, I think the pitfall that I want to talk about today is actually not identifying you actually have a share-based payment transaction. And the big thing with share-based payment transactions, I think there's this view in the world that the only type of share-based payments that exist out there are when we give our employees share options. And that is true, that's a common one. But really, share-based payment transactions are really any transactions that involve goods or services that involve, in exchange for that, consideration that involve our equity. And I'm choosing my words really carefully there, because you don't even need to issue equity or for it to be captured by the standard. Sometimes you're entering into a transaction where the amount of the consideration is based on your share price. You're into the standard. So I think the first pitfall is to really, when you are starting to enter into transactions and negotiate transactions for goods and services, which in any way involve your equity or your parents' equity, somebody else's equity in the group, you're probably going to be captured by the standard in some way or form. So that's first pitfall number one. And the way I'm generally going about it these days is, if you're using your equity in consideration in an exchange transaction, or you are referencing your equity in terms of measuring the consideration, you're probably going to be caught by the standard. So when you're in those negotiations, just start to think that way. And it may not even be clear that you're in the standard. Sometimes organizations and companies think that they're in the financial instrument standard because, it involves their shares. But the trigger here is that a good or service is involved in the exchange. And we'll flesh that out a little bit as we go in this. So
Kevin,
when does this account? So yeah,
I think this is linking to the comment that you've just made. Sometimes people are thinking they are not applying the standard because they cannot identify the specific goods or services that they receive in return. And we're saying, but why are you giving the equity, or why are you making a payment linked to equity? There has to be a reason for it, right? And if it's an unexplained reason, so it's basically you're getting an unidentified good or service, you're still captured within the standard. So it kind of links to your comment. Absolutely.
And I think it links back also to the commercials. Very often, I love it, I sit in meetings with clients and I get told that the accounting doesn't link to the commercials. And I smile because I actually don't think that's true at all. The accounting does link to the commercials. Often when the accounting doesn't appear to link to the commercial, it means because we haven't understood the commercials. And we've had that going through the team a little bit this week about what's the underlying commercial of the transaction, and are we doing the accounting right? And Aletta is very right. Sometimes you don't even know that you're exchanging a good or a service in return for a share-based payment type arrangement. So this is actually in the accounting standard. It actually says there, if the value of what you're giving doesn't quite equal the value of what you're getting back in terms of goods or services, you've probably got a share-based payment, and you just haven't quite identified yet the other side of the entry. And that's really, really important. So I think the pitfall here is really to try and turn it around and say to you, when you're starting to enter into a transactions, you're in your negotiation, understanding the commercials of what's going on. I always say, understand the exchange transaction, what's been given up, what are you returning, and the moment the consideration is either your equity or linked to your equity price, you're probably in the standard. The other place Aletta?
I think it comes back to that good old comment that an entity is never going to make any payment or give any shares away for free. There has to be something in return.
right.
And it's trying to and they're saying here, even if you cannot identify it, maybe it's somewhat subtle and grouped with other things, the standard still applies. So nothing is for free.
That's right. Before I move on to the scoping one, I might just give you a couple of examples in the last 6 months where I've seen share-based payments that we didn't see. I'm just going to rattle them off. There isn't a slide for this. So common pitfall arrangements are all the ones that we've already mentioned. But when groups are entering into SPAC arrangements or establishing special purpose entities for the acquisition of a business or some sort of asset, so those are called SPAC, especially in the US, they call them SPAC acquisitions. The other one is group restructures, and this is intergroup really. When one entity moves assets and liabilities across to another entity, sometimes those assets and liabilities don't meet the definition of a business. They're really just transferring assets across to the other. And you can see already where we ended up. One entity in the group receives all the assets and liabilities of the other entity. It's not a business combination because it isn't a business. It's just a series of assets and liabilities. And then the entity issues shares to the parent entity to create the entity. So you can see the characteristics there already. The new entity is receiving assets in exchange for equity issued to the parent. Doesn't that just sound like a share-based payment? Because one entity acquired assets in exchange for shares in itself. Now, it's not always a share-based payment, but it starts to trigger, are you in the standard or not? So that's one way I've seen it. And then the other one that we see quite often at the moment is situations where the parent is issuing the shares and the subsidiary is receiving the goods. And this can be particularly problematic when the parent is in another country like the US or in Europe, because then you have sort of tax consequences. It's really important in those scenarios to understand whether you have a share-based payment, and we have a slide on this later on, because the entity receiving the goods might not be the one that's issuing the equity. That's somewhere up in the group structure. That's still a share-based payment, and it's still captured by this by this standard. I think we've covered then what's in the scope of IFRS 2. We've spoken about equity settled, cash settled, and the hybrid where there's goods or services coming in where the entity can choose to either settle in cash or equity. Those are the sort of three types of share-based payments. Don't be alarmed, or don't be fall into the problem where you kind of just assume that everything is equity settled. I mean, the base assumption in IFRS 2 is that you're in the standard if you're receiving goods or services, so debit goods or services, and that debit might be an expense or an asset acquired, and credit something, and the credit is equity if it's an equity settled type arrangement. But if you're actually settling it through cash and the cash is just linked to the price of your equity, it's a so-called cash settled arrangement, and then you're going to have a liability on your balance sheet for that. And then the hybrid is when you kind of have a choice of settlement, and there's some complexity around that. Don't default to it's all equity and everything goes through equity. If it isn't obvious to you today, we actually are assuming a base knowledge in the standard. We're just dealing with the pitfalls today, so I'm not going to spend a lot of time on the theory. I might cover it at a higher level, but we'll just try and deal with the pitfalls today. Let's talk about what's not in the scope. What's not in the scope of IFRS 2 or AASB 2 is transactions with employees or other parties in their capacity as shareholder. So this happens a lot because shareholders can also be providing goods or services to an entity in their role as an employee or even a service provider. And I think it's really important to kind of understand the substance of the arrangements or the commercials in that. It's often easy to see when a party is transacting with the entity in their capacity as a shareholder, when all other shareholders are also involved in the transaction. But sometimes that's not the case. The moment you start to have groups of shareholders transacting as a group, or individuals who are shareholders transacting individually, it starts to become a bit blurry about what it is exactly that's going on here. So one of the pitfalls we often find is where shareholders, and this can be like an individual who owns shares in the business, it's not clear whether he's acting as a shareholder or whether he's transacting as a deliverer of a good or service, especially if there's related party arrangements in place. It's really important to understand this because IFRS 2 captures the transaction when there's a good or service involved. And I would like to say that if a good or service is involved, you most likely aren't transacting in your capacity as a shareholder, because a shareholder acts in the equity section of the balance sheet. And the moment a goods or service is involved, you're probably outside of that. The other one is when shares are issued as consideration to acquire a business combination under IFRS 3. This is true, but it's really important to understand what the shares are being issued for, because the shares have to be issued for consideration of a business. Sometimes you have shares being issued at the same time as a transaction to acquire a business, but those shares aren't being issued to the vendor as consideration to acquire the business. It might be going to a deal advisor who's part of the transaction to get the deal across the line. So those shares then probably aren't part of the consideration to the vendor to actually buy the business. They're issued in addition to or at the same time, and IFRS 2 is probably going to capture them. So it's really important to kind of disaggregate and break this up and understand where things are going to. And then when the entity acquires goods or services within the scope of the IAS 32 financial instrument standard or IFRS 9. This is a bit of a misnomer, because that assessment of whether you've got a financial instrument is way outside the scope of today's presentation. It's really important to understand whether you're in the financial instrument standard or IFRS 2, and that's once again going to come down to analysis of the commercials and what's really going on. I guess the point I'm trying to make up to this point is, if you suspect you have goods and services and it's linked to equity, you need to assess whether you're in IFRS 2 or not and make a proper assessment before proceeding to apply one or the other standard. Aletta, any comments before we head on to some of the more the detail?
Nothing from me, Kevin. I think that's good. Thank you.
All right. I'm going to whip through the next the next few, because we've already covered it. What is a share-based payment? I think we've already mentioned goods and services. We've already mentioned the obligation to settle either with shares or in cash that's linked to the price of your equity, or equity in another group entity, often the parent. So that's your definition of a share-based payment transaction. It gets a bit vague, or a bit vague, because there's actually two definitions in the standard. There's share-based payment arrangements and there's share-based payments transactions. So the assessment of whether you're in one of these standards often requires sort of a two-step process. Do I have a share-based payment arrangement, and then do I have a share-based payment transaction? So you've got to kind of work through those two definitions at the same time. But I feel like we may have covered most of the key components at this point, which is really goods and services on the one hand, consideration in the form of equity, or consideration in the form of price linked to equity, or equity of a group member. Those are your sort of key components, which should allow you to kind of fluff around here. When it comes to equity, there's often vesting. We're going to get into that a little bit in more detail in some of the later slides, because obviously when you're issuing equity, you don't always issue it immediately. It's a promise to issue equity in the form of a warrant or a share option or phantom shares, or all these wonderful terms that the lawyers and the legal guys come up to, but they're all essentially in substance the same thing, is issuing or promising to issue equity or equity-linked instruments in exchange for goods or services. Vesting implies that the right to obtain the underlying equity instrument is essentially conditional on certain conditions being met, and we'll get into that as we go through. So let's do it now. What is a vesting condition? Vesting conditions, also assuming knowledge today on this webinar, but a vesting condition determines whether the entity receives the goods or services and the counterparty becomes entitled to either the cash linked to equity or the equity instrument itself. And vesting conditions really form part of two categories: service conditions or performance conditions. Service condition is really when the counterparty or the employee or the supplier or whoever it may be actually needs to complete a specified period of service. And a performance condition is often defined as a performance hurdle, like a target that needs to be met. However, what's misleading with that, and here's your second big pitfall of today, is that by definition, if a performance hurdle has to be met sometime in the future, it essentially means that there's probably an embedded service condition or service period already, which is why under our performance conditions, we've got complete a specified period of service as well as performance target. That's really important, not only to employee arrangements, but also supplier arrangements. When I talk to valuation experts, a lot of them talk very much about performance conditions in isolation. And the reason why they do that is, as you'll see later on, when you value share-based payments, the performance hurdle, especially if it's a market condition, gets factored into the valuation, but it almost ignores the concept of a service period. So the valuers often talk that way, and it's not that they don't talk in terms of periods, but they don't acknowledge the existence of a service period, because that's almost an accounting construct. That's what's important for us. And so what we often find is that valuers will run off and value things, especially if they've got market performance hurdles, because the market performance hurdle is relevant to the valuation, but they will either make an assumption over the service period that either assumes maximum service period or doesn't give consideration to what that service period is, because that's something the accountants have to do. Don't fall into that pitfall or that hole. Performance conditions often go ahead with the service period, because by definition, to get to the performance hurdle, the target, you have to complete the service, or the service is driven by when do you meet that performance. Anything you want to say on that, Aletta, at this point?
Now, Kevin, I think that's good. I don't want to interrupt.
No, go for it. I'm waiting for some war stories, I think, that our listeners can listen to. All right, so equity settled share-based payments. I think it's pretty clear with equity settled share-based payments, you're actually promising to issue the equity. You recognize the equity settled share-based payment as the entity receives the goods or service. And if there's a service period attached to that, you're going to recognize the equity transaction over the service period. So it's essentially going to be spread over the period. Cash settled transactions, cash settled share-based payments, they must also be recognized over under IFRS 2. This occurs when the entity receives the goods or service and incurs the liability. Now, remember, with share-based payments, when you've got a cash settled, you'll have a liability in your balance sheet, not an equity reserve. And you essentially have to factor that in, because what's happening here is the expense is essentially emerging as the liability is accreting. So that might be slightly or look slightly different to the equity arrangements. Not going to get into that. I don't think there's a lot of pitfalls in the recognition of equity and cash settled. Once you've identified the one you're in, I think we generally get that right. I think it's identifying which one you're in is the big issue. And I always like to say to companies who I'm talking to when they're starting out for the first time in these things is, if there's any chance that cash will be paid, you need to evaluate whether you have a cash settled arrangement and a liability. If the only alternative is that shares will be issued, you're probably in equity. And then, of course, there's a spectrum of alternatives between those two, which require a little bit more assessment. I think we've covered this one. I've spoken about the credit side. I did say that there's a little bit of assumed knowledge today, so I'm going to whip through some of these slides to get to the war stories. This, by the way, the slides today is actually created off an article that BDO has on its website. I think, Aletta, it's quite a comprehensive article that essentially goes through all the bits, so it's almost a compendium of how to approach a share-based payment. So if you either work through these slides or actually find the article on our website in our thought leadership section, you know, essentially it's a how-to companion on share-based payments. Right, measuring equity settled share-based payments. This is another pitfall. I don't think this pitfall is too big when the equity settled share-based payment involves employees, but I do find that we make lots of errors around this when it involves an external supplier. If we take the concept of an equity settled share-based payment transaction, as I said already, you're receiving goods or services and you're promising to issue equity. This assumes no cash settled alternative. So really the only thing that's ever going to happen here is the good or service is going to come to you either immediately or over a period of time, and you're going to either promise to issue the equity over a vesting period and then eventually issue the equity. If that's what we're talking about, I think what tends to happen is most organizations go straight into, I've received the service, because it involves equity, I need to value the equity, and that's going to drive my accounting entry. That is true if the instrument involves employees and employee share schemes, because there's an assumption really built into the standard that for employee services, the value of the equity instrument being granted is really a better proxy. And the reason for that is because you can't find a measure of employee services out there in the market. You can't go and look for a proxy transaction to try and measure the value of the service. So you measure, in this case, the value of the equity granted. However, if you're dealing with an external supplier, almost the reverse. You can get an external proxy of the service that the supplier is providing, because what would the supplier invoice you if they weren't entering into a share-based payment? What would their invoice look like? That's what you're looking for. So in that case, you actually measure this based on the value of the underlying good or service being received. Now we've got an example here that involves inventory, and really, if you're receiving inventory from an external supplier, it's the value of the inventory, essentially the invoice they would issue you, that you measure the transaction based. Whereas if it was a supplier arrangement where your employees were involved, you would be valuing it based on the equity instrument. Now, we've given you a couple of examples here. It's the same example, but it essentially shows you in the first entry, when you actually know that the fair value of the inventory is 100, whereas on the second one, there's a presumption here that maybe the inventory isn't the most reliable measure, and so you value it based on the equity being issued. I'm struggling to think of a scenario where this would be valid. It's a good demonstration of the concepts, but I would say that if you are arguing that the inventory can't be valued as a good or service, or there isn't a good proxy for it, and you're defaulting to the equity, I would say there's probably a missing good or service here. There's probably another $20 somewhere, which is actually another good or service, because why are you issuing equity instruments worth 120 in the second example, but only getting goods or services where the inventory on the market is worth 100? And that's a great example of, is there a hidden good or service? But it is true the standard allows you to go through this thought process. It does allow a series of rebuttable presumptions, but the idea behind it is, if you've got a good or service with an external supplier and a reference good or service price, then you use that first and question what the missing good or service is. Recognition of expenses for equity settled transactions. We haven't got too much into vesting today, but the idea behind it is, if the good or service is transferred immediately, it vests immediately. The instrument probably vests immediately at that point, and the transaction is accounted for in full when that happens. Vesting really only comes into it when there are conditions attached to the shares transferring or the options becoming shares, for example. And that normally means that the good or service is also transferring over a period of time, or it's essentially being accounted for over a period of time. That would normally be the case for a service. It would be really weird if you had a good transferred to you on day one, like inventory, but there was vesting attached to the instruments, because then you'd have to ask yourself, why is the equity vesting over a period of time, but the good has already been transferred? That would be a little bit odd. But essentially, vesting generally comes in where the conditions attaching to the equity being vested in and becoming sort of fully transferable or convertible into a share by the holder, it would normally be tied to the fact that the service is transferring over a period of time as well. And then the accounting follows that too. So you'll have accounting over the vesting period. couple of things on delayed vesting. There's a couple of concepts here which I might just kind of jump into now when it turns out about recognizing expenses. This example is quite detailed, and this one does have vesting periods, which means this example is essentially a service being delivered. There's a service period over which to account, but the service period might have variability to it, and you really have to account for the expense over the estimate of the period if it's not already fixed. Now, variability normally steps into these types of arrangement when you've got a service period that is linked to performance conditions. So those performance conditions, like achieving a market price or a revenue hurdle, you don't really know when they're going to be met. You could achieve the market price in the first week. Maybe it's going to take 7 years to achieve. So then not only is the period of the performance hurdle variable or uncertain, but it means the service period becomes uncertain as well. How do we account for those? You need to estimate essentially what you suspect the period of service to be. When do you think the hurdle is going to be met? And essentially account for it over that period, which also means that you'll be updating that period as your estimation changes. Now, what does that mean from a valuation and from an accounting point of view? Because the valuer is going to assume a period in the valuation, and if the valuer doesn't talk to the accountant, what happens is the valuer sometimes assumes that the performance hurdle will only be met at the very end of the period allowed for in the contract. So I've seen an example recently that involved T and P class shares. You'll see those a lot. T and P class shares, I come across those a lot in the last 6 months. They're not new, it's just I'm seeing them a lot in the last 6 months. And often the T class share is a share that you get for a service period. There's the T. And the P class share is often the only condition attached to that is a performance hurdle, like achieving a revenue target or a market target. But the P class share that has a performance condition attached to it often will stop after a given period. So the one I saw recently is the employee had 7 years to achieve the target, 7 years to achieve the share price. The valuer assumed that the share price hurdle would be met at the end of 7 years. By doing that, the valuer had locked us into a service period of 7 years. But when we came to the accounting, the client had assumed that they'd be able to meet that hurdle within the first 18 months. And what that meant was the client was trying to account for it over 18 months because he assumed they could do it in the first 18 months, but the valuer had assumed it would take 7 years to get there. And we had an accounting mismatch between what the valuer had done and what the accounting was trying to do. Now, those things can be overcome, but it's not a great start when the valuer is making an assumption that's different to what the accountant thinks is the answer, and you need to work through those. What do we do? Well, the valuer at that point hadn't actually finalized the valuation, so he was able to adjust the valuation to kind of meet those things. But once the valuation is done at the grant date, it's locked in. And that is why it's important that those the valuer and the accounting entity work together, because the valuation needs to factor in those sorts of variables. You might have a scenario where there's 3 possible outcomes, 18 months, 7 years, or 2 years perhaps. Now, the valuer generally doesn't take period into the valuation, but he may need to Monte Carlo or simulate that in the valuation to make sure any volatility or other variables in the valuation are factored in. So just make sure those things all align. Aletta, any comments on the valuations at this point?
Oh, Kevin, all good. I think you've got this covered.
You did a great job putting the slides together. I'm hoping you didn't throw anything in there that I haven't actually looked at before, so let's see. Valuations, this is not a valuation webinar. The pitfall that comes with valuations is most organizations who are doing a valuation assume valuations are simple. Black-Scholes is the valuation pricing model that the accounting standards make reference to, but in many ways the Black-Scholes model is actually a simple valuation model. It essentially assumes only a number, if not a limited number of variables, and when you have things like a P-class share that's got a performance hurdle that's linked to revenue, sometimes it's also linked to IRR, and sometimes it's linked to an IPO liquidity event. So really, there's so many alternatives that can happen. Then Black-Scholes is probably not a good pricing model. So this is when we have things like Monte Carlo simulations happening. But the Black-Scholes pricing model is the base model that the standard refers to. It's a simple model that assumes a relatively small number of variables, and it is a good pricing model when you are evaluating European type options. Those are the sort of options which really can only be exercised when an agreed future date occurs at a pre-agreed price. So really, your service type share option schemes, which really just have a service period, employees got to stay, Black-Scholes will be good. American type options, those that can be exercised at any time before an expiration date at a pre-price. So what's happening here is got variability in the period. The binomial is a little bit better. And then when you start to add things like IRR and performance hurdles and maybe even liquidity events, so the things can vest immediately. You know, if there's an IPO and a liquidity event, you might find that you start to head towards Monte Carlo. The pitfall here is you need to understand when you need to bring a valuation expert in. Most organizations can do a simple Black-Scholes without involving a valuation expert. Most organizations would need to involve a valuation expert if you're heading towards binomial and the sorts of Monte Carlo simulations where there's a little bit more you know, complexity. Now, this slide might be a little bit misplaced in the presentation because I've been talking about these things like you've during the whole session, that you know about what's going on here. But really, the pitfall here is to essentially make sure that you identify the types of conditions attached to your shares: market conditions, non-market conditions, and non-vesting conditions. They all have different accounting implications. What's really important here is that market conditions are taken into account when you do the valuation, whereas the other conditions are mostly taken into account when you do the accounting. Valuers will generally know that. Accountants are maybe not always so clear on that. So there's the pitfall, making sure the finance people and the valuation people are talking to each other. The one I've seen in the last 6 months that seems to trip everybody up is a hurdle that's tied to revenue and IRR. What does that do? Because a revenue target is probably a non-market condition, but an IRR is not so clear, because what is IRR? IRR sounds like a profit target, but it's often driven by a return on the price, on the equity price. So it suddenly sounds like a market condition. So if you've got an IRR hurdle in your share-based payment, just make sure you get some advice on where that sits, because IRR is all driven by, it's an internal rate of return, but it's generally a hurdle that's driven both by profit as well as a reference to share price, and sometimes it's got a revenue target or a revenue hurdle attached to it as a second hurdle. The one I saw recently, which I've seen before, but once again I'm seeing them more and more, it's essentially got a table that says these are the number of shares based on the IRR and at the same time based on the revenue hurdle attached. So it's essentially mixing a variety of these all at the same time. You really need to break that apart and make sure the accountants know which part belongs to them and the valuers know which part belongs to them and how they interact. That'll be my takeaway on market and non-market conditions. What happens after vesting with a share-based payment reserve? The standard is unclear, except in one situation. A share-based payment reserve does not go back to profit and loss. That's the only thing that's really important in the standard. But sometimes these reserves sit on the balance sheet. We did this early in the year in terms of decluttering your financials. And one of the easiest ways for you to deal with a share-based payment reserve is to essentially take it back to or against retained earnings within equity. And most organizations do that when the instruments either vest or are cancelled or modified in some way. So it doesn't hang around permanently on their statement of equity, but it never goes back to profit or loss. And then modifications and cancellations. I just want to actually talk very briefly about this. we could almost do an entire session on modifications and cancellations, and we could even do a part 1 and a part 2. That's how many complexities go here. But my advice to you on modifications and cancellations is this: no one does a modification or cancellation without there being a proper commercial reason for them, and often that commercial reason is because the employee, especially in an employee arrangement, isn't really ever going to get the award. So you might have set the hurdles too high, like a performance hurdle. And so what you tend to do is you modify the award so that at least it's within range again. Now, this is especially true for long-term schemes. You might have set up a scheme 3 years ago that assumed that a market price of X could be achieved, but what's happened since then is the economy's tanked a little bit, and there were a cost of living crisis, and so the market price might have collapsed a bit. So the hurdle is unachievable. Essentially, it renders the share scheme not worthless, but there's no incentive anymore to the employee. So you tend to modify it. What a lot of organizations do is they get the steps wrong in the modification. They don't really modify it by saying this scheme is replacing that scheme. What they tend to do is cancel the one scheme and then replace it with a new one a couple of months later. Just because of the sequence of events, their intention was to modify the scheme, but the series of steps they've taken suddenly creates a cancellation, and the accounting is so much more worse under a cancellation than it is in a modification. They're both bad in a way, but the pitfall is that the organization rushes to communicate to a client, to the staff, I'm going to replace the scheme with another one. What that means is you've canceled it, and then you wait a couple of months to replace it. That's not a modification unless you follow a series of appropriate steps. What you've done then is canceled it and replaced it with a new one. That has accelerated vesting implications. Most schemes that are a modification or a cancellation generally means that you accelerate the vesting in some way or form, which means you end up with whatever you haven't recognized already as an expense gets recognized when you either do the modification or cancellations. But there are ways to spread that damage over the period of the new scheme if the new scheme isn't a cancellation. So just make sure you get some advice before you do anything on these. And I think the best advice is don't communicate anything to the market or the employee until you've spoken to somebody, because the moment you communicate to the market or to the employee that there's going to be a change, you've already triggered the change. And then you probably already have a world of pain and tragedy. I feel like Aletta wants to say something here, or...
Yeah, I just wanted to say, Kevin, I absolutely agree. Cancellations lead to an immediate expense of everything you haven't previously expensed. So it just happens all at once. But if you modify, yes, we have a bigger expense potentially, but we at least still spread it over a period of time, simplistically. So I think this is one to be very careful about. I agree with you, and we see this quite a bit. Yeah, so just get advice.
My first question to anyone who comes to me with a modification or cancellation is, have you told anybody? And if the answer is yes, the accounting advice looks different. If the answer is no, we can help you. If the answer is yes, we can help you still. We just help you differently, because by then the damage might be done already. Right. In the interest of time, I'm going to kind of jump over some of these. I've spoken about cash alternatives and cash settled. I think the answer there is, if cash is involved and it's linked to the price of your equity, you might have a liability on your balance sheet. The accounting is holistically different in that scenario. But it is true, we mostly see equity share schemes, especially employee share schemes. Nobody really deals with cash settled alternatives unless they have to. I think that's probably fair to say. The other thing I will say, though, both in terms of cash and equity settled transactions, which I don't think we have a slide on that is, but these things are designed from a tax point of view to be called limited recourse or limited recourse arrangements, and sometimes they seem to be underpinned by a loan. So you give a loan to the employee so they can acquire the shares once they've hit the hurdles. Generally in accounting, the loan is a misnomer. The loan doesn't really have any substance. What generally is happening is you've got a share-based payment, you've got an expense and a credit that's either equity or liability. The loan itself isn't a loan because it doesn't really have substance or any recourse or even limited recourse. So if you've got a limited recourse loan or even just a no recourse loan, don't expect to see a receivable liability, asset on your balance sheet because the employee is never going to pay it. And that's something that I think we've dealt with over a number of years, but I still seem to get that question a lot. Aletta, is I've got a loan with the employee. Why don't I have a receivable on my balance sheet? And the reason is the receivable doesn't have any substance. You just got a share-based payment. I think, Aletta, we'll call it at that point.
Yes, thank you very much, Kevin. I do apologize. I've really thrown you into the thick of things here by having some IT issues, but thank you very much for that. As always, how BDO can help you, if it's IFRS and corporate reporting assistance, a lot of aspects that we can help. I threw in an old slide around lease accounting here, Kevin, because at the moment, a lot of clients, as they're finalizing their 30 June accounts, are running into the age-old problem of how do we apply IFRS 16 efficiently, effectively. But we've got a few slides in there around how we can help you from an IFRS perspective. We also have some slides around sustainability, which Kevin can click through. And thank you very much for joining us this month. Next month, we'll continue the journey. And thank you to Mark Pisacala to also come and talk about BDO Connect. Thank you very much.
Thank you. Bye, Aletta. Goodbye, everyone.
If you can just go through right till the last slide.
Right till the end.
Don't mind. Yes. Thank you very much. All right. Thank you, Kevin. Take care. Have a good day.